Hi, my name is Saniel Chandrawat and I'm Co-Portfolio Manager of Mirae India Sector Leader Equity Fund. We are positive on the India equity market and here are the key reasons why. India is well positioned for economic recovery, corporate earnings are at inflection point, reforms have been the priority for the current government, focus on Make in India campaign, and lastly, India Internet, value creation likely for the next decade. We discuss below each of the above briefly. India is well positioned for economic recovery. Historically, jump in forex reserves is a precursor for economic uptick. 2015 to 2019 saw an economic disruption from demonetization, GST implementation, and cleanup of prior cycle corporate debt. Benefits of huge digitization, infrastructure like roads, electrification are yet to be felt. We believe there are limited historical excesses, low level of household leverage at 18% to ensure quick recovery in 2021. Initial signs are visible in the uptick of property registration and better asset quality for financials. Quick update on COVID-19. The wave 2 appears to be declining and various cities and states have gradually opening up. We have now seen responses from the government as well as private sector to address the current situation, including emergency approval of Russian COVID-19 vaccine Sputnik V, Cadilla's Verafin approval for treatment of moderate COVID-19 patients, as well as diverting oxygen supplies for medical use. We expect vaccination supply to ramp up from July 2021 onwards. Nifty is likely to end FY21 with an earnings growth of 14%, contrary to expectations of cuts or decline at the beginning of the year, one of the best in the decade. Nifty FY21 EPS saw a revision of 17% since October 2020, marking 2 consecutive quarters of upgrades. In contrast, we have seen continuous earnings cut in the previous quarters. K-shaped recovery is a global phenomenon. Most coronavirus job losses are in low wages services sector. Reforms are part of the long-term strategy to support increase in manufacturing activity within the country. As an example, labor law reforms will dismantle archaic hiring-firing norms and the Inspector Raj. To lift the investment cycle, we are seeing opening up of coal, defense, regional airports for private ownership and investments. To boost domestic manufacturing, India could be a key beneficiary of multinational corporations in having diversified production facility across the region. Privatization of non-strategic government companies, agricultural reforms including dismantling of APMC and Essential Commodities Act to allow fair price discovery for farmers and encourage investments from corporates to ensure adequate implementation by states on ease of doing business, power and local body reforms. Make in India was gaining momentum pre-COVID. The expectation post-COVID is with realignment of global manufacturing. India could potentially benefit from the shift in manufacturing and supply chain by offering comparable or better terms than other countries regionally in Southeast Asia. Initially launched for mobile phone manufacturing, the government extended production-linked incentive scheme to 10 sectors with incentives amounting to Rs 1.46 trillion over the next 5 years to promote domestic manufacturing. The sectors include automobiles and automobile components, advanced chemistry cell battery, steel products, ACs, LEDs, pharmaceutical drugs, telecom and networking products, electronic goods, technology projects, food processing, textiles and solar PV cells. Domestic value addition is expected to grow from current 10 to 15% to 35 to 40% in case of mobile phone and 45 to 50% for electronic components in our view. On the consumption front, PLI could create 200,000 direct jobs and 600,000 indirect jobs in the next 5 years in our view. India internet sector is at an inflection point to witness hypergrowth in the coming years, with tech companies steadily disrupting the traditional services. A supportive government, tech-savvy young population, 60% plus of Indians are below 35 years of age. Ongoing digitization of SMEs, and a well-funded PE/VC ecosystem suggests that the stars are aligned to create investor value in the coming decade. The majority of tech companies' models are focused on top 100 million affluent users. These are now expanding to cater to the next 100 to 200 million as credit availability is helping drive usage. Total e-commerce industry will grow to $107 billion by 2025 from $33 billion in 2020 with a CAGR of 27%. We expect e-commerce to be the third largest online vertical following fintech at $300 billion and logistics at $160 billion. As discussed above, we are positive on the Indian equity market. And just to summarize, we believe India is well positioned for economic recovery. Corporate earnings are at inflection point. Reforms have been the priority of the current government. Focus on Make in India campaign. And lastly, India Internet, the value creation potential for the next decade. Thank you.